stock of the day, which is Challenger. So the company is holding an investor day, and it has published the update to the ASX. So again, when it comes to what we're hearing from Challenger, it says that it expects its bank sale to be complete in the first half of FY24. It says that Challenger Life will remain strongly capitalized and that it is expecting normalized pre-tax net profit to come in slightly above the midpoint of its previously offered guidance at between $485 and $535 million. So the stock of the day is Challenger Financial. Scott Phillips from the Motley Fool, I'll start with you. It's, look, not a company that we talk about a lot, I think because sometimes it could be perceived as a bit boring, but it is yes. Looking and sounding to me like it's mildly upgraded its profit outlook. It doesn't happen all the time in this environment.
It doesn't indeed, and not for Challenger in particular, mate, which has had a really tough run over the last few years. The market likes it, shares up about 3%, so that's some sign that at least it's buying some friends or making some friends when it comes to what it's trying or planning to do and the progress of that sale, as you say. This is a business I've got to say, we recommended it a while ago at Motley Fool Share Advisor. We ended up selling it, or recommending members sell anyway, because it was just a really significantly underperforming and consistently underperforming business. And it's a really interesting one because every now and again you get a business that on the surface should be a good company. These guys sell particularly their annuities. They sell to retirees. In a very volatile market, you would assume a business like this, and I'm going back multiple years now, should have been able to make a case to potentially nervous retirees, not someone watching this program probably, but people who've got a superannuation fund or they're about to hit retirement, they've hit retirement, they're not wanting to take on the risk or the volatility that comes from investing in shares, want to turn their portfolio into that kind of annuity income stream. It should be, frankly, a slam dunk sell for a really big superannuation pool, and for a lot of people who just don't want the uncertainty of superannuation being invested in active stocks. So ordinarily, you would have said, we did say at the time, this should be a business that can make every post a win and really continue to grow along with the retiring boomers, growing superannuation balances. The market was made for Challenger. It's just never been able to really get out of its own way. It keeps tripping over its own feet. 13 times earnings, not particularly expensive. I mean, in a financial space, nor is it particularly cheap. But it's one that, as I said, should be able to do better than it is. Sometimes you just find those businesses that just simply, despite the fact the macro should suit them, don't seem to be able to really grasp it. That's Challenger for me. I don't know I'd rush out to sell it at the current price. It's not particularly expensive. 3.9% dividend yield, 13 times earnings. It's pretty run-of-the-mill. If you own it as part of a diversified income portfolio or something, I can kind of understand it, but I wouldn't rush to buy it either.
Okay, so Challenger is actually one of the best performers right now, but on a day that it's pretty lackluster out there, let's just call a spade a spade. So, Luke, Challenger Financial, I don't know if it fits into your style of investing, but if you did just want a steady as she goes income stream, do you see any attraction here? It's up by 3% today.
Yeah, I see the attraction for Challenger's products, as Scott was talking about. The annuities make a lot of sense, and it's a market that Challenger dominates. But I completely agree with his point. It's a business that's never been able to capture the tailwinds available to it. And part of the reason for that, to go back to your introduction, Dean, you said it's one that doesn't get a lot of chatter, not only on the call, but in financial media in general. And I think that's because it's actually a very, very complex business. I mean, I encourage viewers, if they have the time, flick open Challenger's Investor Day presentation today. This is not a simple business to go through. Financial analysts, you would sit down for a week or two to really pass through all the different segments and how they're moving, the capital requirements in each of them, and sort of what they need to what they release. Because at the end of the day, this is a spread business. They promise their customers a certain payout on their annuities, and they have to earn a higher spread to generate income for their shareholders. So look, for me, I actually agree with Scott's conclusion. I don't think it's a fantastic business. It is pretty safe. It's pretty defensive. And admittedly, fair play to management. It's not one I looked at in a while. If there was one thing I would have thought that would potentially be a huge headwind to a business like Challenger, it's rapidly rising bond yields. And they've actually weathered the last couple of years pretty well and look like that's stabilising coming out the other side. So you're not paying a huge valuation, decent little dividend. I'd be happy for people to hold it.
All right, so there you go. Stock of the day, Challenger.